What's up everybody, Nate here, and Larry McDonald, one of the earliest predictors of the 2008 stock market crash and financial crisis, now believes that the stock market is going to outright crash in the next 60 days. Larry was a stock trader on Wall Street during that great financial crash, and now he believes that economic conditions like the Federal Reserve raising interest rates and consumers going more towards saving rather than spending is going to cause the stock market to fall 30%. That would be a further decline than what we saw in 2008, 2001, and the stock market crash of 1929. And he's not the only one saying that. Michael Burry, David Rosenberg, Robert Kiyosaki, and others are all saying the exact same thing. The stock market could crash within the next few months. Now, the reason that McDonald and all of these other stock market experts are saying that the stock market could crash sometime soon is for three major reasons. The first has everything to do with the Federal Reserve and their interest rates. So the Federal Reserve has been eyeing a target range for their interest rates of a little over 5% since pretty much the middle parts of 2022. However, the Fed has been looking at the recent unemployment data and the recent consumer spending reports, and they're realizing that they might need to hike those rates a little bit higher than expected. This means that we could see interest rates of a little over 5% to maybe even 6% by the end of 2023, and these interest rates could hang around for the foreseeable future. Now, right off the bat, that is going to put a lot of pressure on investors and consumers who are looking to get a loan. Consumers are not going to be able to afford as large of a loan if those interest rates go up even higher, like say for a mortgage. The way that you qualify for a mortgage is if you can make the monthly payments, and with interest rates hitting around 7% in the United States, millions of Americans are going to be disqualified from getting a mortgage. You can say the same thing for anything that has an adjustable interest rate, like a car loan or credit card spending. What that means is that consumers are not going to get a mortgage. They're not going to get a car. They're not going to spend as much on a credit card because all of that debt is really, really expensive to take on, and they can't afford to pay it back, let alone take out the loan in the first place. So spending is going to go down. Spending going down means that businesses are not going to be making as much money. It means banks are not going to be able to make as much money, and if they can't make as much money, well, then they're gonna have to figure out ways to cut costs so that way they can survive on the revenue that they are making. And you guessed it, that means more layoffs. And that is exactly what we have seen over the last 6 to 8 months or so in the United States. Companies have been laying off employees by the thousands because they're trying to cut costs and they're not making as much money as they were, say, in 2021. Now, businesses don't rely solely on consumer spending because at the end of the day, that is really risky, and nobody knows what the trend is going to be for consumer spending because consumer spending determined by a variety of different factors and for different regions of the United States. So they also rely on investor liquidity. That is part of the reason why we have the stock market in the first place. It's a place for investors to now put their money behind businesses so that they can grow and expand outside of what consumers are actually spending on. We even have private markets where VC or venture capitalist investors take their money and put it into startups so that way they can grow and invest in their ideas that could potentially change the entire world. But investors don't always spend their own money because that comes with taxes, and it comes at a really big risk to them because if they spend their own money, now they have less of it to do anything else in their entire life. So they tend to borrow money. Now, over the last couple of years, borrowing money has been really easy for investors and consumers because interest rates were near 0%. The Federal Reserve wanted to incentivize Americans to go out and spend because pandemic conditions were really softening our economy. This led to a lot of spending and a lot of expansion in our economy all at once, but it also meant record high inflation. Inflation can't just go up forever. Things can't just go up forever without any sort of consequences. So what ended up happening was we have this big inflation problem. The Federal Reserve started to raise their interest rates to kind of control it and bring consumer spending down, and now you have investors who are not investing nearly as much money as they were before. That massively affects businesses. Businesses are not able to invest as much, so they're cutting costs even more, and that means that they're laying off even more people. And tens of thousands, if not hundreds of thousands of Americans have their job on the line here. And if they lose their job, well, now they're not able to make their debt payments, and they have a much harder time going out and buying all the same things they could before. So that is the first prong to this sort of stock market crash that could potentially be coming in the future. And the second prong has everything to do with consumer spending. Now, if you look at the numbers, consumer spending is still pretty decent in the United States. If you look at the Consumer Sentiment Index from the University of Michigan, consumer sentiment is pretty positive as of right now. Consumers believe that they can go out and spend a lot of money. However, if you look at the rest of the data, well, consumer spending is in a really tricky spot because yes, consumers are spending, but what money are they actually spending here? Savings accounts for consumers are getting drained. So now people have a lot less savings than they did back in 2020 and in 2021. Household debt is also starting to go up. So we're seeing Americans take on more loans and use more of their credit cards in order to pay for regular everyday goods and services or just anything else they want. And finally, there has been this big boom of buy now, pay later. So consumers are financing everything and everything they are buying, like a new pair of sunglasses, a grocery trip, you name it. Now, there are a few different reasons for this. For one, inflation is still really high in our economy. It's around 6% in the US, and while that has come down from its record high of over 9%, it is still way too high. So Americans' wages and their salaries are not keeping up with what inflation is today. That means the value and the buying power of their money is going down, so they're spending a lot more just to buy all of the same things. Their wages can't keep up, so they're using their credit cards and loans and buy now, pay later in order to buy more things. And the second biggest reason is that Americans have had a lot of money to spend over the last couple of years because of stimulus payments and raises at their jobs. Americans have been going out and spending. The stock market boomed in 2021. It set a new record high, so that meant there was all of this extra liquidity for businesses, and businesses were turning around and hiring a ton of people, maybe even hiring too many. A lot of the people that got new jobs during this time were looking for a raise because they lived through the pandemic. They lived through a time where their job was not super secure. They lived during a time where they didn't love their job, and now they're looking for something new. So businesses, in order to attract new people, were giving them a lot of incentives like better pay, better benefits, work-life balance, you name it. That came at a cost that sort of contributed to inflation, and now you had a record low unemployment rate. So more people were employed, so more people were going out and spending, and that was helping Wall Street to go up even further because all of these businesses were raking in record profits. Now, though, Americans are not spending as much money because they don't have as much money. Millions of people are blocked out of the housing market. Millions of people are spending way too much on a car payment. The average car payment is over $700 right now, and they're not able to use their credit cards because they're beginning to get maxed out. And all of that raise money, all of that stimulus money that Americans have collected over the last 2 or 3 years is slowly being used up, and eventually Americans are not going to have the income to survive in this economy, meaning they are going to be cutting their spending on only the essentials. That could drastically bring down the stock market because now pretty much no business is getting that extra cash that they need to survive. And it'll trickle down to not just in the stock market, but to private markets as well, which means startups and innovation could also be stunted in growth this year. Now, number 3 is debt. So we obviously have a debt problem for Americans, but we also have this big debt problem for businesses as well. If businesses can't get the investor liquidity that they need through the stock market or through private investors, they will take on a loan. Now, historically, over the last 10 years or so, interest rates have been extremely low. So businesses have been able to grow faster and faster and faster because they're taking on loans that have a near 0% interest rate. That means for a business, borrowing money has been traditionally really easy because they're able to pay it back. It actually makes a lot of sense to do this because you can actually maximize on your profits by borrowing a few $1 here and there. So for instance, if you were to borrow around $5 billion and you make $20 billion, well, now you can easily pay off that money, but you can do it way slower and it's not as big of a risk for you. So now you have businesses and firms on Wall Street who are hundreds of billions of dollars in corporate debt. They have taken on so many loans, but the problem is a lot of those loans loans come with an adjustable interest rate. That means with interest rates going up from the Federal Reserve, those interest payments on those loans also go up. And remember, this is now a situation where businesses aren't getting as much money from consumers or investors, so they are getting pinched on how they can actually afford those payments. Now, what you're probably thinking here is, well, just take on another loan. If they just take on a loan to sort of consolidate the rest of their loans, then that will sort of fix all of their debt problems. And historically, that is exactly what businesses have done. They've taken on new loans to pay off a lot of their debt, and everything was great, except for that might not be an option with interest rates hitting 5 and 6% from the Federal Reserve. It's just way too expensive, especially when you have hundreds of billions of dollars in debt. So the situation is businesses have taken on way too much debt, and now they're trying to figure out ways to pay it off, and that could accelerate layoffs and all of the other problems that we have. And what you have at the end of the day is companies pretty much not making anything in profits because their debt and their costs are going up way too quickly, and that signals to investors that they need to pull out. And if enough people pull out all at once, well, we have seen exactly what that happens, like in 2008 and during the 2001 dot-com bubble crash. Now, to be clear here, none of this is to say that this is going to actually happen. No expert, including me, knows exactly what is going to happen in the future with the stock market. The stock market could go up, the stock market could go down. Nobody really knows for 100% certainty because nobody can see the future. And this information isn't to scare you, but it's to make you aware of what's going on, so that way you can become financially educated enough to capitalize on the opportunities that come. More millionaires are made during recessions and stock market crashes than pretty much any other time in American history, and it's because the financially educated and the wealthy know what to do. They buy assets during these times because asset prices are going to go down. That's exactly what a stock market crash means. Asset prices are coming down. With that being said, being prepared and being financially educated is the most important thing that you can do right now. Nobody knows what's coming next, but you should know what to do with your money when the time comes, and that is exactly what we talk about on this channel 7 days a week. And if you haven't subscribed yet, you should definitely do that. Staying in the know is just as important as you probably know, which is exactly why our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.